All right, welcome everybody. Another episode of the Property Web. I'm Tom Carr. We've got lots to get into today. I am really positioning this one as a bit of a wake-up call. And there will be times in your life where wealth building and property investing is a big thing. But there's also a moment where you actually need to really build financial defense. And it's something that we don't always talk about, but things can happen in life. And so today's guest is someone who can really help explore that, amongst other things. Today, I'm really happy to welcome Roger Sousa from Aspirin Financial. And Roger is someone who brings a wealth of experience and we can learn a lot from. So, Roger, welcome.
Thank you very much, Tom. Great to be here and great to be part of this.
Yeah.
Hopefully I can pass on some good strategies and some suggestions to your membership base.
Yeah, and I think we'll just keep this open because you come with plenty of experience. You've been around the blocks.
Yeah, I've been around for about 25 years in this industry. There's been a lot of changes, but we're still out there doing what we do, and that's helping clients navigate, a lot of things that happen in the marketplace, with wealth protection, wealth building, retirement, and so forth. Yeah, but it's constantly changed, but I like that excitement.
Yeah, absolutely. And this is an industry that's probably changed more than others. It's been through royal commissions, and there was a big shake-up back then. But what sort of, if we kind of were to wind the clock back, what was it that got you started, and where? What was the sort of background to Roger?
Look, I started at an early age, and I just wanted to get out there and earn some money. I basically, at an early age, at 18, I owned my own real estate business. So that's got a bit of investing behind it in the property sort of side of things. Had that for a few years, built that up. And then when I sold it, I was still fairly young, and I said, what can I do that is similar to that? So I got into financial planning in 2000 and been in it ever since. So that's how I ended up with, because it had a similarity to financial planning. Financial planning is about wealth creation, wealth protection, retirement planning, superannuation, and property as well, and all those sort of things. So it relates to a real estate agent and investing in that area.
Oh, that makes a lot of sense. And this was Sydney back then?
Yep, Sydney. It was based in Sydney, so that's
Sydney
basically
local?
where I've always stayed and done my apprenticeship, whether it was real estate or whether it was financial planning. So, yeah, I've been here ever since.
And what was the industry like back then, sort of 2000s? I mean, I've got no concept of...
Oh, look, 2000, if we have a look back, 2000, let's pick some numbers. There would have been maybe financial planning numbers or financial planners would have been maybe 32,000 planners. Now we're down to half that, around 15 to 16,000. And it's just basically the new education requirements, the Royal Commission, and all these sort of things that have come into play that hopefully have put us in a better position. I think it has. We're now a profession, and we've got more credibility in there as well. So I think it's great for the guys that have stuck around. But obviously, like any industry, there's still some bad apples that we've got to wean out. But it's all very positive, and I think it's great for us that have stuck out of it.
So the Royal Commission was in part a lot of extra education needed and sort of training for the people who were staying in to sort of get across the products.
Yeah, look, there's a lot of it had to do with education. So it was lifting that sort of basis up requirement and getting becoming a profession and having more credibility. It was also because there was a lot of products aligned to financial planning businesses, for example. A lot of the banks were aligned to a lot of their distribution of products. Okay. So that was looked at very carefully. So that's no longer the case. So that's where a lot of the financial planners just left the industry. And also the requirements for education has just been lifted substantially. So, but yeah, look, it's definitely very good for the ones that have stayed in it, but that doesn't mean we're not going to be immune to anything that doesn't go wrong, especially people always find that they're making money out of financial planning is a proper way. We certainly don't believe that's the case, and we always look after our clients' money as if it was our own.
Yeah, and I've had a bit of experience of that now with referring clients, and so it's always been really eye-opening to me how much care you do take with people, so that's great.
Thank you, Tom.
So a bit of an odd question here, but like, given that you are in your industry, what if you wind back to when you first started that real estate agency, what kind of lesson, or what do you see, what lessons did you gain from that, or what would you do differently back then? Like, were you building your wealth in the way you sort of recommend now? Like what sort of tips would you have given yourself back then?
Yeah, look, I certainly put a lot of that into practice. And one of the most important things I've learned was that you've got to stay the time. You've got to stay in the market. You have to have different assets working for you at different times. Property is a perfect example. I first bought an apartment, had a car space for $42,000. I won't mention the area, but it was $42,000, and in 6 months' time, I made close to $30,000 on it. And I thought, geez, this is fantastic, and I kept doing that a few times. That property, I would say, it would have to be $800,000 or $900,000 now. So it just means that people need to stay the time and believe in what they're investing in and have different assets. Just keep them for the long term. Long term's the play, because you just don't know what's going to happen in 6 months. So you have different things, different assets working for you. So the thing I can take out of all that is basically just keep investing and have different things working for you.
And when you say different assets, are you talking about different types of property asset or sort of just shares? What are your sort of...
So you can have residential property.
Yep.
You can have commercial property, industrial property. You can have direct shares. Just diversification of all that. You might have a business as well. So that's another thing. You might have property owned in different structures as well for different sort of tax benefits and protection of your own accord as well. And you might have a business. So they're all different sort of assets and things working for you at different time, because if I can do it, anyone can do it. It's just that I've built up my expertise and I pass that on to people.
Yeah, awesome. Okay. So I guess you get to see through, you work closely with people's finances. Ultimately, you're about understanding what they can do differently, what they can do better, what the future might look like. What are you seeing that people really have a blind eye to? What are they missing in a big picture?
Oh, look, they're missing a few things, and unfortunately, I look at it as if they've got some blinkers on and they're just looking a bit straight ahead and they're not looking from side to side. And so, most importantly, they don't plan, and they don't plan sufficiently to give them enough time to get to where they need to get to. So people don't know when they're going to retire, and if they do, they're leaving it too late. So what I mean by that is we might get a prospective client come to us for advice, but they tell us that they're retiring next year. So I believe you need to give yourself 10 or 15 years, if not longer, maybe 20 years, and plan right from the outset, straight away. So they're not giving themselves enough time to reach a goal, and some of their goals might not be realistic. So they need to also have a view, okay, what is it that they want in future? So if they're going to be retiring, when is that date and what is the figure? Once we know that, we work backwards.
Okay, so people will come to you, that figure they've got in their mind, it would have been great had they come 10 years before, because you could actually implemented different strategies.
Yeah, exactly right.
Yeah,
because let's take an example, and this is probably using a client scenario.
Yep.
Client might be working now and they're earning 150.
Yep.
Plus bonuses, 200,000. So super-wise, they're going to probably need close to 2 million on that. They're in their age 45, so they might have 400,000. So as you can see, there's a big gap between 400 and 2 million. So how are they going to get there? So we need to position and have a roadmap to actually put that in place.
Okay.
Because the way that they're probably going at the moment, they're probably not going to reach it.
And do you see what that sort of impact is when people do come to you at the right time? Like, is it there are ways to get to that sort of magic number? Are there?
Oh, look, certainly. And once we know what they want in retirement,
because 2 million, I guess, is not necessarily for everyone. But
I'm just using that as an example. Someone might only want about 50,000 a year, so then maybe 1.2 or 1 million might be enough.
Yep.
Correct me if I'm wrong, but you probably might not know many people that have 1 or 1.2 million at the moment in super. So you sort of think, okay, maybe this person's going to struggle to get to 1.2 million. But if they see you earlier enough, 15, 20 years, then I think it's quite achievable. And we've had that scenario happen, quite a lot, and it is achievable. It is achievable. Because I've been doing this since 2000. I've had clients with me since approximately that time, and I've seen their progression and how things can happen in a 25-year period.
So is there a psychological element here? I'm guessing there is, but how do you help shift people's mindsets? I mean, if they do come early enough and you get them to realize that there is a number that they need to be working, or that they need to change their ways, how do you actually play a part in that? Or
look, for sure. I mean, a financial plan is very important.
What is the process, I guess? What are the mechanisms in place to make sure that they're accountable and so on?
We review our clients at least once a year.
Right. Okay.
So that is part of keeping them accountable, getting on track, and so forth, because things do change. People go through different life stages. They might be divorced or have kids come along. Kids get married. They want to move homes. They want to buy an investment. So a lot of people's lives change. And people also move as well. They move from Sydney to Queensland and all these things. So we're their advisor, so they sit with us and say, Roger, I've got this planned. How's that going to affect my retirement? How's that going to affect the plan that we discussed before? What changes can we do? And we're onto it. So because a plan is only a start, that plan we can then change as things change with the client. We're there to hold their hand. We're there to review it every year. Any new legislation changes that we can optimise the client's position, we'll be onto it. So it's quite valuable. Financial planning, I believe, is one of the most valuable professions that a person can have right by their side to guide them through. Yeah,
I agree. On paper, and I definitely agree that it is an amazing service that you offer. But I do hear people they're concerned about having those conversations, whether they're, again, psychological or whatnot. But I was trying to think about this, and I mentioned financial defense early on because when I bought my first home, I wasn't even aware that I need to get in sort of insurance. I mean, obviously, buildings insurance is an obvious one, but there's all sorts of other things that you should probably be doing to protect yourself, because it's not just about building wealth. I mean, building wealth is important, but you also don't want to be losing either. You don't want to be losing your home, or what happens if you lose your job or you get injured. You still want to maintain your lifestyle and your family's lifestyle. Can you talk to us a little bit more about what financial defense might mean? And are people even thinking about this?
Most people don't. They don't think about that defense mechanism and what they might have put in place. Most people think that the insurance that they have in their super will be sufficient.
Right.
But 9 out of 10 times that I ask a client that comes to me, do you have insurance in your super? Do you have insurance at all? They wouldn't even know.
I mean, I think this really. I've got a personal story of a friend who was on my street, and he really unfortunately, great guy. He had a serious injury, and then he got infected. He actually ended up losing both his legs, and it was terrible. He's got completely through that. He's a very, very positive person, but there was a 2-year period there where he was not able to pay his mortgage and support his family. Having said that, he did have insurance, and he had the foresight to actually go out, and he also spoke to his financial planner, and he was able to get those things in place. But it's not everyone's hearing a story like that, and not everyone's really aware that those things can cover you, right? And if you don't have it, it's difficult, right?
Oh, look, it's really difficult. We hear a lot of those stories, but it's we can reiterate it to the client, explain to them this is what might happen. Look, sometimes it comes down to the cost, but you want to be at least having something.
Well, actually, why don't you talk about that? Because there are 2 ways that you can go with the cost. Well, there used to be. So putting it in super is still an option, or paying
again. Having a look at the client's overall position as a financial advisor. First of all, we look at their cash flow. So how does their cash flow look like? Is it going to be sufficient enough to keep the insurance outside the super? Because that's the best one. That's the first one generally that we look at. And from a client's perspective, if the cash flow is good, we tend to go that way. And especially there might be some tax deductions with the income protection and so forth there. Then if their cash flow is not as good, then we look at the superannuation. part of it, because then it's paid via the super.
Yeah.
So that's the second part. But first and foremost, we discuss with the client their liabilities, their family, who they need to support if something was to happen to them, and so forth. And then we start from that point of the maximum cover that they need, and we work backwards in regards to the cost of the premiums and see where it falls in line. Sometimes we might say to a client, look, I know you feel this is inappropriate in regards to the premium amount, but this is the optimum start, and then we might come with an in-between there where at least they've got some cover, and at least it's going to get them through that difficult period so they can keep running with it without selling down what we call their castle, because they've spent some time building this, and to then lose it and spend the last 10 years paying for these things and building their wealth and then all of a sudden lose it, it's hard to start again.
It's difficult. No one likes insurance, right?
Yeah,
but it's about the loss, it's the risk.
Look, as an example, we all insure our car, we insure our home.
True. Yeah.
If we buy an investment property, we have the tenant's insurance and all that if they default, and landlord's insurance. Some of us even have our mobile phones insured if it drops and cracks and all that sort of stuff. So there's a lot of insurances there that we just take it for granted.
True.
But you know what? We need insurance for ourselves, because if we don't insure ourselves, we can't pay for those other items.
Yeah, it's so true. Yeah. So why don't we shift gears towards the wealth building and what perhaps people coming into their 40s, maybe they've perhaps already bought the house. They're thinking about that next step. They may be even thinking about retirement, even though it's still quite far off. What are people? What are they not thinking about that they need to be doing, or what are the key things that you would really want to get across to them?
First and foremost, I would think that they need to plan. Doesn't matter whether it's 5 years off retirement or 20 years off retirement. They need to have something, what we call a roadmap or an advice document, to put them on a roadmap and say, okay, these are the stages that we're going to look at covering and ticking them off. So they want to be paying their home loan down as quick as possible, because that gives them the potential to actually use the equity on their home to build wealth. Mm-hmm. And so it gives them that next stage to actually work towards retirement. So even though retirement's still some years away, you're actually putting little steps in there to actually work to building for retirement, even though they might not think it is.
So what does that look like in practice? Let's say they've got $1 million home, they've maybe paid off 30-40% of it,
yep.
And they come to you, we want to retire in 20 years, this is our situation. What is an example? And you can change those numbers, but...
Yeah, look, those numbers are pretty spot on for a similar demographics of clients that are sort of out there in that space, and sort of I would do a bit of cash flow and identify where's their expenses and living costs and so forth, and mortgage, anything that relates to where they're spending money, where is it all going? So, because most clients, they don't know where their money's going. Mm-hmm. I always had a motto, even when I was in real estate and so forth, being a young fella, that you pay yourself first, then you basically have the rest, for your expenses. Because if you pay a 20% to yourself first, that gives you opportunities to invest that 20%, put that away. Mm-hmm. Then you put it towards your expenses. If there's not enough to put it towards your expenses, that means you're actually spending too much.
Okay, yeah.
Okay, so people have got to identify where are they spending their money. Most people are overspending, and they don't even know what their living costs are.
Yeah.
Where are all the costs? How much are they saving? I'll ask someone, how much do you think you're saving? Oh, I think I'm just living day to day. So, well, that's already a problem. So we've got to work and identify that.
Okay. And so there's surely a lot of online help out there. We've got ChatGPT, we've got calculators and apps, and surely we're being sold the dream from the technology that's out there. What is it that is not doing that maybe you can do? Like, is that something you can speak to?
Look, every industry uses technology now, and without technology, my business wouldn't be the same as what it is today. So technology is always going to improve. It's going to get better. But I still believe that face-to-face relationship that you have with a client, whether it's over the phone or over a Zoom or a Teams meeting or even like we are now today, is far greater than actually pinning in, typing in a few numbers and a bit of a scenario into ChatGPT and your AI system to get a result, because that is not necessarily about you. That result that they're going to fork out and give you is not a true representation of Tom Carr's financial situation and his retirement.
Do people hold things back, do you think? Is there part of the process that sort of there's an unraveling that happens when people get more comfortable with you?
Well, look, as people come on board as clients, we do know a lot about them, their family, their kids, their dogs, cats, you name it. We know a lot about their situation, and it's very important. And our business, the people that work in our business know them, and it's like a family. So, look, there might be sometimes we don't know something that hasn't been quite disclosed in some aspects, but generally we would know everything about the client. And as financial planners, we do have a knack of extracting information, because if we don't get all the information we require, we know that there's going to be a gap there. So we don't want any surprises. We don't want the client to get any surprises down the track. So it's important we know everything. And clients are generally upfront when it comes to that.
Yeah, and without the transparency, you're not necessarily setting them on the right track.
Yeah.
Okay.
It's a bit going scenario. It's a bit going like going for a loan, and you don't disclose that you got a credit card with a limit of 14 grand, and then that comes up on a credit report, and then Tom's asking them, "You didn't tell me about this." "Oh, I didn't think you know." So you sort of know. You would have asked them, "Have you got any other? Have you got credit cards, personal loans?" All this other stuff. So you know what, from your experience, and experience is a good thing, that you'll ask and search for these
things out. So maybe shifting a bit more onto that retirement topic, because I think retirement's an interesting one, isn't it? I mean, people are talking about it quite early on these days. I mean, people want to just sort of set up their passive portfolio and just shift off to Bali and retire early. I'm guessing you're not really a fan of that, but...
Oh, no, look, I have clients that actually ring me and will say, because I've told them in their reviews and told them when we first set up their financial plan, you told me I can have a trip every year for $10,000. So they'll ring me and say, or ring my staff and say, I want to take out $10,000 because Roger said I can take it out to go on my cruise holiday. So we actually set funds aside each year for a cruise holiday, or to go to Tasmania or whatever it might be, or at Cairns, or to go to Uluru. It's part of the plan. So we know, and they'll call up and say, "Oh, Roger said I can spend this money on my new canoe." Yeah. So we've got a client that purchased a new racing canoe, right. and they're in their 70s, if not close to 80. They race in their canoes.
So you're kind of building in pockets of sort of fun, I suppose, or kind of excess.
Look, it's not just all about expenditure. It's about having fun, living your lifestyle. Because then, what's retirement then? You know,
do people kind of even come to you with those ideas, or do you have to seed them? Like, is it?
Generally not. I think those ideas come as it moves on.
Okay.
Because at age 40 or even 50, people generally won't say to you, "Oh, I want to spend my retirement years traveling each year to Greece or to Brazil or do something, out of that they don't expect." So, but as they get closer to retirement and so forth, they're starting to say, "Okay, I think I'm going to want to need this every year." Okay. And then we allocate that. But you can't allocate that expense if you haven't planned to at least have a buffer or build enough assets to be able to give you that opportunity.
And this is something that's coming much later, sort of.
So it's coming much later, but we've actually started building a portfolio or assets, so it allows you that opportunity. Because if someone came to you and said, "Oh, Roger, I'm going to retire next year," what sort of magic could you do? And what doesn't give you much room then to do a few strategies and so forth that you could have probably done 10 or 15 or 20 years ago and use those strategies along the way.
So the retirement age is 65, isn't it?
Look, the retirement age, people say it's 65. I say, look, you can retire any time as long as you got the money.
Yeah.
It's a retirement age there. Generally, people would say it's 65 because that's when you can touch your super.
Mm-hmm.
Yep. Or it can be age 67 as well. But age 65 is generally the start of age pension age as well. So if you haven't built enough assets, you haven't got enough super, you could be falling into that part where you're going to need part of settling help, which is the age pension.
Yeah.
When we see clients and when we put them on an early plan and they've got a lot of years up their sleeve, we want to make sure that, and then we try our best to not get them thinking about an age pension. We want to build their assets so they don't have to rely on the age pension.
Yeah, I think people would naturally want to be in a position not to go that, because that's the safety net.
You'll be surprised. There's some people out there that will come to us and say, because we've got 3 financial planners in the business, that we all do a great job. We've got 800 plus clients that we look after in the business, and they'll come to Roger, I want to get the age pension.
All right, okay, I've contributed my life.
I've paid taxes. I've helped this government and all the other governments. I've helped the businesses. I've done what I've done for Australia. I need to get the age pension. And so basically, once I explain to them, look, you want to sacrifice this just to get this small amount in age pension. It doesn't make sense. Let's get you to build your assets, build your income up, and then you won't need to get $30,000 in a full age pension, or even $10,000 in a part age pension, and so forth. Let's build your assets so you've got $2 million, where then you can have $120,000 plus in income.
Yep.
But at least you've got an asset to touch that you can draw some money out. You go on holidays, you've got enough income instead of earning $30,000 in age pension. It's a big difference. And the other important thing, Tom, is that most people are earning 100,000 plus. Yep. So 100,000 plus to then drop down to 30,000 in age pension, or 30-odd thousand.
It's big. Yeah.
It's a big drop. So you got a lifestyle change there. So I don't think it'll be a good idea just to look forward to an age pension. It doesn't matter whether you're going to get something small. I can understand some of the benefits of the medication and not having to pay for that and getting discounts here and there because you're on an age pension. But in regards to income, I know what I'd be choosing. I want to have more assets to it so I can ensure myself more income rather than try to get the age pension.
Yeah, and it's likely not just about you, it's about your family and the broader people around you that you want to support.
But by that time, it's you and your wife or partner, and your kids are sort of moved away, but you still want to have some assets potentially that you can help the kids, because they might have a large mortgage, because as you know, it's not going to be easy to get in the property market as time goes on, prices keeps going up. So some clients will say, I want to help the kids. Yep. So again, you want to build their assets to give them that opportunity rather than relying just on an age pension.
Yeah, okay, awesome. So I did, on the opposite end of that, I suppose, is there a sort of cash number that's too big? I mean, do people sometimes just have a cash balance in super? I mean, is that effective, just to put it all in standard shares or cash? I mean, do you like to see property in everyone's portfolio, or is it case by case? Or
look, all asset classes are good. To put in any sort of portfolio, because diversification, and because not all asset classes are going to be working and making you money at the same time potentially, because things move in different lines. And that depends on the economy, interest rates, and so forth. But yeah, we like to be more diversified across the board. But if a client comes to us and say, look, they're pro property, and we're not negative on property. We also like property. It's part of an overall portfolio. We find it's very beneficial to have property, and it will always be part of our discussion, because it's a wealth creation mechanism. It will help you get there, especially if you're borrowing, you're using other people's money to be able to buy a bigger asset, and you can, we will utilise and analyse the potential to have property in a portfolio, in a self-managed super fund as well, and see whether it's the right fit, because it's all about the cash flow as well for that asset class, because it's a big item.
And I think with the SMSF, that's also something that you can really help people understand. I mean, there's a lot of news and sort of media about that and lots of online info, but you would actually sit down and really explain the pros, the cons,
Yeah. Again, that's a
and the setup, I presume.
Yeah, that's a direct asset class. So you've got residential, and then you've got commercial, industrial. Look, we don't give specific property advice, so we won't go and tell them to buy 2 Smith Street and Smith Valley.
No.
But we'll
the structure.
We'll use the figures that the client provides to us, or their buyer's agent or real estate agent. So that will be, okay, what's the cost of the property? We'll calculate what the stamp duty is. What are you going to receive from rent? What are going to be the expenses for this property? So we put that all in the cash flow. What's going to be the repayments, the interest rate, and then we put that on that cash flow so the client knows, are they in surplus, or are they going to put more money themselves into this investment? And that then forms part of their plan and their strategy moving forward, whether that's appropriate. Generally, we find it's appropriate, but we always recommend the client to seek advice with the buyer's agent, the mortgage broker, and an accountant and lawyer. So the accountant will help us put the self-managed super fund together, if that's appropriate. So we'll make mention of that in our plan to the client, and then we'll be in discussion with the accountant to then set that up. But look, a self-managed super fund is well talked these days. Most property people are recommending people, once they've used up their personal sort of side of borrowing and being able to get into property, is to look at the self-managed super fund side of it. But they don't go through with the client, the cash flow and stuff. Really, that's very important to see whether this is going to work.
Yeah.
Because I've had a few scenarios where the clients set this up, bought a property, and then all of a sudden the cash flow is not right, and they have to put a lot of money of theirs into it, and that you can't just put X amount of dollars into it, because there is caps of how much you can put into super. It becomes an issue there. So I don't believe people that are recommending from property investment perspective really do the scenario properly for clients, but we do. We do the cash flow and make sure that this is appropriate, because our hat's going to hang on it.
Yeah, okay, awesome. Well, I think maybe just wrapping up with the last question, I mean, for anyone out there who's sort of feeling maybe a little exposed, they not so confident about their expenses, they're perhaps considering a financial advisor, or just what their next step, what retirement might look like. What is one thing that you can kind of just give to someone who is feeling a bit sort of financially nervous, let's say?
Yeah. Generally, everyone's got superannuation, so they should be getting some expertise to review that, because there is thousands of superannuation products out there. Yep.
Right.
Same with insurance, same like property. There's a property in every corner. As soon as you're making a financial decision and it's going to affect or be part of your retirement, I feel you should be seeing a financial advisor. So generally, everyone has an opportunity to engage a financial advisor. I wouldn't be concerned or afraid on your situation. I would just be reaching out, because you might be just missing an opportunity. The longer you leave it, the harder it becomes to get to that goal. And whatever that goal might be, which we don't know until we identify during the meeting, it's all about income and when you're going to retire. Because everything we're building, you and I and everyone, it's basically about the future, about the retirement part. We want to have enough money so it enables us when we want to retire and how we're going to retire. And so I would say to people, at least speak to someone, financial advisor, a broker, accountant. Get your expert team, which I'll classify the A team. Always have those in place, because you're going to be able to at least discuss something with one of those people. So I would say get onto it very quickly.
Yeah. All right. Awesome. Roger, thank you very much for coming on. It's been a pleasure having you here. Just remind people how we can get in touch with you.
Perfect. That's always good, Tom. Aspiring Financial Planning is my business. I'm Roger Sousa. You can also go onto our website, info@aspirum.com.au. You can also reach us on our office number, which is 02 9621 6111. Or you can also send me an email, which is rsousa, that's RSOUSA, at aspirum.com.au.
Perfect. And I will put that in the notes as well. Thank you, everyone. Roger, and thank you for being here, listeners, on the Property Podcast. I've been Tom Carr, and I will see you next time. Thank you.